I'm Todd Gordon, and I can't believe it. It's been 8 years since I launched this business, and what a ride it's been. Welcome to TradingAnalysis.com. We're one of the leading education, analysis, and trading alert companies on the internet. We are a team of devoted professionals who trade our capital in a live, transparent manner to show you what the life of a trader is actually like. Keep in mind, this is an industry filled with smoke and mirrors, with cheap sales and marketing tricks, so it's been my mission to run an above-board, transparent, and brutally honest operation to serve our clients in the best way we know how to prepare them for life in the markets. Every single day, we offer video and written analysis for the major trading markets, including stocks, stock options, cryptocurrencies, and Forex markets. We offer live and clear-cut and actionable trade alerts in these markets, and they're sent straight to your cell phone and posted in the members area on Trading Analysis. Once the trade is out, we certainly don't leave you hanging. We follow up on every trade, whether it's a winner or loser, and we'll conduct post-trade forensic to show you what went right, what went wrong, so you learn. And very soon, I'm going to be sharing my real-life seven-figure portfolio with our members who prefer the longer-term investment timeframes, with some medium-term trading and option strategies mixed in as well. So head on over to TradingAnalysis.com after this show is over. Take a trial today and join us at our community. Let's get back to the show. Hey traders, Todd here. Welcome to the Wednesday live stream. It is Fed Day, and a lot of excitement here. This is a big one. Every Fed meeting is huge. So it looks like they're going to go 25. And it's all about how Jay Powell addresses the banking crisis, as well as a lot of evidence of easing inflation. Market has acted extremely well. We're starting to trace out the early makings of something motive off the lows, which means the new trend is in place. We've had a lot of stability in rates. So there's a lot of good things happening. Continued rotation into growth. I'm pretty bullish going in here. We've been building positions in our portfolio and our stock swing desk. We have some option trades at work. We'll take you through there. We'll show you the indexes. We'll give you a little macro overlay, and take as many questions and comments as we can. Let's bring the team in. Good morning, Trading Analysis team. What's up, guys?
Morning,
Alex Terry,
guys.
welcome.
Hello.
Hey, good morning, guys.
What do you think?
Good afternoon to Alex, right? So
Yeah. Guys, what do you think here? Opening comments. What do you think about heading into the Fed? It's now spring. What do you think?
jump in there, Alex.
Yeah, so maybe Jerome Powell will, I mean, from both sides, if you look the situation, as we talked on our macro Monday for clients, situation is that first, they only know how deep this banking crisis is. I think, my opinion is, as I heard yesterday, Lagarde speaking of continuation of the rates higher, that situation in this banking sector is contained, and that actually Jerome Powell will separate inflation outlook with the current banking crisis. But from the both perspectives, inflation is moving lower. Fed target rate for now is set to go stable, maybe this 25 basis point move. And then we will have, of course, new CPI, and they're gonna set the rates for some time of the period between 4.75 to 5, and then until the end of the year, we might even move lower. So I think that will be the narrative. I think Jerome Powell will try to calm the markets regarding the banking crisis, to explain what's going on there, and actually to say they're still track to take down inflation. But as we talked, I think the both situations are kind of a Goldilocks. The one will react just sooner if the banking crisis extends for them to stop, and actually if we go into some major crisis, they will reduce. But if the banking crisis is contained and they see in the system that is not spreading anymore, he will push the inflation narrative. But since inflation is still moving lower, we might be for 25 basis points move, and they're going to say they're still going to be data dependent, which means that we're going to wait for the next CPI.
Yep, exactly. Yeah, so the one thing I'm concerned about here, Alex, is those housing numbers were that month-over-month existing home sales up 15%, the highest move since like 2020, which was a month-over-month change from pretty extreme readings. So on the shelter component, I'm a little concerned by that. And one of the things I was going to look at here, we'll take you through the indexes at the top. We have stability in rates, but again, food and shelter continue to be a big driver in inflation, and those housing numbers were very strong. And if you look at, as we've been talking about with our members, you look at where 30-year mortgage rates are, the spread between mortgage rates and the 10-year yield, which is the key determinant of 30-year fixed. It's the largest spread since 1986. So even more so than the global financial crisis. So what that means is mortgage rates are going to come down. Everyone's telling us we're going into a housing crisis. Well, collective they are wrong, I think. Housing is showing a lot of stability and is going to continue to be a driver. So a little concerned on that. So really, I'm just concerned how Powell is going to be able to address the inflation. There's obviously signs longer term that it would be coming down. But go ahead. You want to jump in?
No, I just want to say the housing also, this is a very, I think, especially in US, a seasonal market. So if we look, I think seasonality, maybe now it's a little bit more time of a buying than it's not.
It is, but this was a huge move.
Yeah,
this was
a huge move, but we might see some internals why that's happening. So I'm not that much concerned with this rates outlook and the current situation that the Fed is going to push narrative. We're going to stay bullish on inflation, bullish on rates, because the housing moved in 1 month for that percentage. I mean, for me, that will be a concern, but if it's repeatable over the months, then it's they're going to act on it. So probably they have the internals of that situation. Fed never reacts on a, in my opinion, on one set of data. They wait repetition actually to point that out. So my opinion is they're going to juggle between the 475, 525. And kind of, you say food. You're completely right. Food is rocketing, especially in Great Britain. Inflation there over 10%. Over 10%, and food is the biggest component because they import everything. But look, commodity prices, everything is moving
it's getting
over.
Smoked. Yeah, I agree. I mean, we can flip through commodities right now.
So the inflation retail prices usually stay longer because they're through the kind of a sample. They tend to move slower once they go up because you need to compare that with wages, and there is all relation between the wages and food, and then when the demand stops, they will have to crash that prices if commodities has to move lower.
Well, hold on. We're talking about a few different. We're talking about a few different things here, right? So you have shelter pricing, which home sales is starting to be bid up. Yes, there's some degree of seasonality to it, but I am thinking that people are just getting into houses that they wanted to get. The 30-year mortgage is stubbornly high. People are expecting to be able to refinance lower. So housing prices have a floor. The other good part is we had labor force. The labor force is breaking out. People are coming back to the workforce, which that's going to take some of the wage pressure off. If we continue to have a strong economy, obviously people are going to be spending more, want to make more, but labor participation rate went up, so people are coming back. That's going to help. We're debating it. We've just got to see. It's going to be the market reaction to what Powell says. It's not what Powell says. It's how the market reacts. And we're just looking for key phrases and the way that Powell can present this very sticky situation that he's in. how he presents it, how he structures it, and how the market reacts. And if the way the market's acting, especially in the fixed income market and equities, right now heading up into it, it's kind of, I think it's kind of setting up to be a Goldilocks situation here. You know, and Alex, if you know, we can just flip through commodities here real quickly. You know, here's let me just try to pop this out here a little bit. We're kind of going off our normal flow here, but let me just show you. Let's just flip through some of those commodities, and I'll roll into the indexes here. So this is your. Let me start with the Bloomberg Commodity Index here. Right in the lows. I've overlaid with emerging markets, the dollar and yields, but we're looking at white. That's the Bloomberg Commodity Index. Copper showing a little bit of a bid here, not a valid wave count. I got it. Go ahead. Go ahead. What'd you want to say?
No, I just wanted to say that the overlays, I mean, copper is still kind of a sideways, but if you go through, of course, we know oil is down, corn is down. I mean, softs are down. So
let me just go through it. Let me just. I was just going to go through every one. Okay. So let's start with the energy. So here's gas going into summer driving season, pretty contained. Crude oil hanging right around the 60. Actually, it's come back a little bit. I was thinking we'd get down to the 62 area. Pretty good little fib support. We've made a very big move up. You gave us a support area in XLE. We can take a look at that. Actually, let me flip that over. We're kind of going off script at this point. We had a plane coming in and we're off script. That's fine. So here's XLE, and Alex gave us this support zone, which I thought was really, really good in the energy ETF. Still think it's in triangulation in XLE, but the support from 76 down to 74 was good. So we're looking within the industries, within the energy sector that might have a little bit of a rebound play. So that, you know, that's obviously not disinflationary. So that's crude oil. This is a triangle, so we know triangle precedes the final move in a motive wave. So if this is perhaps C of Y, we could be moving closely into a low. As I said, I thought we'd get 62. We got down to 64. Here's natural gas, continue with the energy. We're doing a kind of a double bottom here on the 786 retracement. Deeply oversold post, obviously a lot of geopolitical pressures. From the 2020 high to 2022. A little bit of support there. Gold trying to break out. And then copper, we already showed that. Nice little move. I'm not really sure what the wave count is here. You can't put a 3 and 4 here. A lot of people will do this, but it's not accurate because this is clearly a 3-wave move in 3, so that's not correct. And just kind of flipping through the other commodities as we're heading in here. So here's cattle, here's hogs, feeder cattle. Those are looking good. Cotton sideways, coffee sideways, wheat lower, corn sideways to lower, cocoa, sugar high cocoa, soybeans, sugar. So, you know, nothing crazy. And then lumber. You know, I'm looking at lumber over XHB. And, you know, we're coming off the lows a little bit, but certainly we're off the 1200 high. So commodities are somewhat muted, I would say. I'd agree with you, Alex. And then let's, as I said, we're going totally backwards here today. And it all hinges around the 10-year yield. Just give me 1 sec. Let me finish this thought, and then I'll let you guys jump in. 10-year yields, again, we were looking for resistance up here, 408, 401. We've dropped off nicely. We're holding range lows. I think the best situation here for rates, and don't forget, rates and commodities have a macro correlation for sure. Lower the rates, the higher the inflation expectation, the higher U.S. yields, lower inflation expectation. And if lower inflation expectation means the Fed takes the foot off the gas pedal, that means stocks are going to go. So that means stocks and interest rates have an inverse correlation. Stocks and bonds have a direct correlation. So if we get a little bit of a, maybe just a little bit of a push up, if we can exist here between 3.4 and 3.8, I think that's ideal for the equity market to continue to go. And not only that, but rotate into growth stocks, as Terry will show us. Terry, go ahead. You were going to say something?
Well, yeah, you stole all my thunder, but basically, I got two things. Let me go back. Let me go back and say the thing about the housing number going up 14.5%. And one of the clients reminded us, the mortgage process is typically a 30 to 45 day closing. So you kind of have to, it's not the interest rate of the mortgages today and those housing numbers. Remember, all of that stuff the Fed's looking at is lagging data. So we're talking about people initiated the purchase of those homes, 45, 60 days ago to get into that, when we saw a little bit of a dip, when they were able to lock in those a little bit lower mortgage rates. Now, mortgage rates probably have accelerated somewhat since then. So that was one piece. The second thing is, while the spotlight was on financial sector last week and the dramatic drawdown we saw, did anyone happen to notice that the energy sector was actually the worst performing sector last week, right? So crude oil prices collapsed all the way down to $66 a barrel, and they pulled back slightly, back up to about 69. I think I'm looking at futures today. So that pulled a lot of energy stocks down with it. What's the correlation with the Silicon Valley Bank failure and energy? Those two aren't directly related. I can't believe they're directly related. So there's other things that's going on that people really, they're distracted, let me say that, by this financial situation and not really looking at the overall inflation picture. Energy coming down is good for inflation. It's good for all the other industries. It's good for the farmers. All the mechanized industry is good when they see low energy prices. One of the sectors or the industry groups, Todd, that you and I are interested in is that steel and iron industry group in the materials sector. And we know the materials sector is kind of weakening, but inside there, that iron and steel group is still dramatically outperforming. And guess what? The steel industry is a heavy user of electricity.
And
it used to be coal, right?
Gas too, yeah.
The steel mills used to be driven by coal. No longer. They're driven by electric driven kilns, and that electricity is being produced by natural gas. So plentiful natural gas in the United States, $2 a million BTU for natural gas, prices that we had 30, 40 years ago, right? That's incredible savings for those guys. So that's what I want to say.
Got it. Fish says we look sad on the live stream here over in Trading Analysis today. All right. So how do we trade this? How do we make all of this actionable? So where are we? What Terry was saying, as we go into KRE, right? Banks coming off, that's going to be disinflationary. That is viewed to push inflationary forces down. It's being reflected in energy. Steel is a sector or an industry group within materials that we're looking at quite heavily. And a lot of it's coming from Chinese demand, the Chinese economy coming back on board as they're open for business. So KRE, we're completely out of sync on this one here. So we're just going to go all over the place here. KRE is going to be your daily chart here. We've pulled back into, potentially you could make the argument that's 5 up, 3 down. We're into the 618 retracement in KRE, and we've just been kind of hanging here after the initial push down. It's been sideways since March 13th. Here we are on the 22nd. Really not making headway one way or the other, but we've seen continued rotation out of the banks and into growth stocks. So if you just look at KBE, so this is just your regular bank, your banking ETF. Since March of 21, you can see the relative strength into the S&P is dropping. It's been declining since 2021. So, financials, is that a key driver, of this economy? Do banks need to continue to have profitability? It's not a concern with the Fed. I don't think that's a big deal. So interest rates stabilizing. We're now at 4.75 to 5 in terminal Fed funds. Maybe we go to 5.25, but they are pricing in cuts at the end of this year. I don't see that happening I don't know why the Fed would cut, and I don't want the Fed to cut. I want to go into investments knowing the Fed has some elevation to react if another situation unfolds, or we have another shoe to drop, or we're not out of the woods with regional banks that are over leveraged and paying their deposits too much. All right, so let's get into it. So S&P finally broke this little consolidation here, which is great. So let me get rid of that visibility less than that. So little downtrend line here that you otherwise would not have seen, and that is going to be sourced from the following. Let me thicken this up here a little bit. Format. Audio. I'm going to turn you off real quick, Alex. Okay. So what we're doing here is, if you just source the lower support on the decline in the S&P, make a parallel, and then push it off the highs here, right? We've just broken through yesterday going into the Fed. So this is the daily, get down to the half day, get down to the 1 hour, and it's, we need a little bit of we need a move today to get some separation here for this wave 3. Right, so wave 3 is of the sub-minuet degree. That is going to make the 5-wave move up of this impulse right here from the March 15th low. So we need a good 5-wave move. So we're at a 100% relationship of green 1 compared to green 3, 40.29. We'd like to get a little bit more of a bid here in this third. That, keep in mind, it's wave 3 of a higher third wave. So we would like to see a little bit of a move post-Fed, and if we get the Goldilocks situation, I think that's going to unfold, and then that starts to suggest that we are beginning to move higher in an impulsive fashion. As I said, with the stabilization in rates, we're seeing a better move in the NASDAQ. So if we got to the daily, this is going to be our bullish count, which I am tracking a diagonal off the lows here. It's not a typical diagonal, but diagonals have kind of been assigned a lot of different, very specific and I would say unnecessary rules since R.N. Elliott provided the world Elliott Wave back in the 1940s and 50s. But we have the heart of a diagonal happening here, 1, 2, move up in 3, pull back in 4. And then what is key is going to be Groundhog's Day, February 2nd. If we can break February 2nd high at 12,892, that is going to all but cement the 5-wave move from these lows. And 5s are pointing in the direction of the trend. So I've been pretty steadfast, bullish. A lot of people like to push back, and they're saying down here, no way are we moving higher, no way are we moving higher. Well, look what's happening. So looks like we might have a 5-wave move to go. And so inside of the daily, let's get down into the 60-minute. And here's what we're looking at going into the Fed with the NASDAQ. I am aware that we do have a potential 5-wave move from the lows on March 13th. So if that's the case, we might have to weather a 3-wave pullback here. Okay, so we have a 5-wave move. We've got some fib resistance in a 12,907, and it looks like we might be on the decline. We have several positions going. I'm sure Terry's going to show us a rotation into growth. One trade that we are working is Tesla, and we are working call spreads here. Seem to be working very well. We put on a 190 200 call spread. I'll show you the live position here in a second. I forgot to log into my platform. I'm going to let that go here as the boys are talking. I'll come back and show it to you. But Tesla seems to be breaking out. We are carrying a 190 200 call spread. We bought it back here. And we're up against a 100% relationship in Tesla. I'm kind of thinking that if we get the move here that we're looking for, a stronger move, it's going to take us through a key 78% retracement. That's your retracement of last resort of this February to March decline. and 204 is, I would say, breakable today. And then eventually I'm wondering if we get up to this 1618, which is going to be 161% of subminuet 1 off of 2. So we're looking to kind of extend possibly Tesla on the upside. And then another one that we're very, very focused on is some of the semiconductors. Not all of them. SMH in general is looking amazing. But we're looking at 1-2, small degree 1-2. We have a very obvious shelf of resistance, I would say ceiling. We're trying to break through there, and it looks like we do have some clustering, 280, possibly up to 300 in SMH. Now, I am not lost that we could be in a corrective rally. That possibility is not lost on me. So here's a bearish semi interpretation, but for our purposes and the way we're trading right now with our portfolio, with our options trade, is we have cleared the first resistance zone, and it looks like even in a bearish situation, we should have another push up into 276 to 280, the next fib resistance zone. So even if this is a corrective rally, we have another $30 to go in the SMH. Just flipping back, here's our bearish count in the NASDAQ. If we break, again, that February 2nd high, that really challenges this triangle count that says this is triangle B and we are going to fail and we are heading lower, sub 10K in the NASDAQ and down to 3,200 in the S&P. The S&P has not seen the rotation into tech and growth, obviously, because it's got more exposure to other industries, and it's not in danger of invalidating the triangle like the NASDAQ is. But if the NASDAQ does break that upside triangle, the implications are, if this is going to be let's say this is the low. This is going to be an A, B, C. This is X. We still have A, B, C. We still have higher to go in line with that SMH. So even the bearish count, if we break this, I'm happy to eliminate this count right here. We still have 13, 14, 14, 5 in the NASDAQ on the upside, if not more, based on the bullish count. So interest rates are stabilizing. Inflation seems to be coming down. We have a little housing pressure. We've seen really good rotation. Sentiment is extremely bearish. People are still convinced we're going into recession, and it's got the makings for a pretty explosive upside move. And we're going to get more and more aggressive here as we've been putting a lot of cash to work in our stock swing desk at Trade Analysis. I'm pretty heavily tilted towards growth and my wealth management. I still have cash on the sidelines, looking to deploy that. So. Can't wait to see what happens. Terry, I'll send it over to you if you're ready, sir.
Sure. Yeah, we're going to be tactically deploying our funds as we see opportunities come about, and we're here using the Optima platform. Go ahead and switch me over, Todd.
Okay.
And let's start with taking a look here.
You're up.
Oh, look, it's working now, Todd.
Well, that's what I told you. It's working. That's what I said. It's working now.
We were having issues before we started with my screen. My transfer wasn't picking everything up, so I had it all scrunched. Okay, won't worry about that. So, already made the point about financials and energy, but this is last week's price performance in the sectors, and we had a 1.43. This little purple bar right here, column, represents the S&P. We made a 1.43% gain last week, right? In the face of this big meltdown that we had here in financials. And like I said, while everybody was focused on that, nobody was talking about what happened to this red bar here. This red bar here is the energy sector. I'll pull this over and show you the actual numbers. This is last week's price performance, close of Friday. S&P up 1.43. Look at the NASDAQ. The NASDAQ was up last week, 5.83%. Look at the push here. Notice that on close of Friday, the S&P was still below this red line, which is the 200-day simple moving average. On close of last Friday, the NASDAQ had already pushed back above the 200, the 50, and the 20-day moving average, and well above that. So this is that whole impulsive nature, the tech stocks coming back in, because we know the index is more heavily weighted in tech, and the S&P has got much more of the value trade in there. So that was almost a 3 times move there, right? Energy was down 6.85% on the week. Financials was down 5.92. Somebody should be digging into what's going on with that right there. Let me bring something over and show this with you here, and see if I can make this bigger. So, you know, a lot of the price of energy is related to supply and demand, right? And what you see here in blue, this is the weekly U.S. crude inventory levels. The gray area represents the 5-year range of these inventories. So prices should be somewhat stable in the energy industry when you're sitting inside the range that you're comfortable with. Whenever you get outside of these bands, there's obviously stuff going on. We had a period here back in 2022 when crude inventory levels were well below those 5-year bands, right? So that's that was concerning, and then crude inventory got back in range, and now it's accelerated, and so this is the forecast for that. We also have gasoline stocks that we look at. So the inventory of gasoline is also tracked in a similar fashion, and you can see for the U.S. our gasoline inventories are back inside the 5-year band right now. And as we move into the month of April, the U.S. will be transitioning from distillate mode to gasoline mode in the refineries, and that's primarily in anticipation of the U.S. driving season, right? U.S. Typically drives their cars on vacation a lot more in the summer than they do in the winter, and that's what drives that demand for gasoline. Okay, so this week we were up, as of close yesterday, 2.2% in the S&P, up 1.77% in the NASDAQ. And so you can kind of see, well, that acceleration has kind of slowed down a little bit, but it was most of that acceleration was last week. So I think we're getting a bit of a bounce back, and you can see energy bouncing back somewhat with the crude prices going from 66 back up to 69. Financials have bounced back somewhat, but we still have the growth sectors moving higher. I'm going to flip over here, and we're going to talk about that rotation that we see in growth and value on the weekly RRG. The IVW is iShares growth vector, and you can see that moving higher into the improving quadrant with this northeasterly vector means that week over week for the last month or a little bit longer, we've been seeing large cap growth reaccelerating towards taking a lead, while consequently that means that value is rotating out of favor. Even on the smaller time frames, I'm tracking that right here. On the daily rotation, that turnabout happened back here, I will say, the 1st of March. So from the 1st of March to now, we're at the 22nd, right? We've had about 3 weeks of market action there. All of that has been growth led. Looking here on the growth and value distribution, you can see for this week, everything is in green, everything is up. We do have value slightly outpacing growth this week, but consequently, that's just again my interpretation that most of it's a bounce recovery that we're seeing. And if we take a look here, this is using the Dow Jones Large Cap Growth Index instead of the IBE. So the Dow Jones Growth Index Large Cap Growth is already pushed into the leading quadrant here. And these are all your value sectors, your large cap value, mid cap value, small cap value. All of those have now faded out of position. Now, there was a time a week or two ago where we were bragging about and noticed the fact that we actually had small cap value tracking in this northeasterly trend along with the small mid cap growth vectors. And then there you can see the large cap was playing catch up. Well, suddenly, recently, we've had a shift out of those small caps. You can see that hook and that turn right there just happening over this last 2 weeks or week and a half period here. That there's a turn that's happening. Those small caps seem to be fading somewhat, and then now, but we still have the mid cap and the large cap growth. So it's mostly dominated. The trade is mostly dominated, I believe, by that large cap push. Here is the sector relative strength sector leader scoreboard, and we've been tracking communication sectors moved over into the leading quadrant. Look how rapidly the technology sector, just a few weeks ago, if you don't watch this show regularly and you pop in every now and then, you're like, oh my God, last time I saw this, you know, we were still way back here in technology. Fast forward to today, there's been a rapid acceleration, especially this last week in technology. That huge move that's really pushing that. So I wouldn't be surprised, Todd, to actually see technology overtake the communications in terms of relative strength anytime soon. That really doesn't matter. That's just finesse. Now, our third sector that we consider growth is the consumer discretionary sector, and this is where Tesla sits. Tesla and Amazon are the two large market cap stocks that drive the XLY aggressively. And we've seen them rotate back into favor. We had been tracking real estate for a while. Real estate had moved up into this improving quadrant, and I urged caution as I saw it start to rotate downwards before crossing over into the leading quadrant. And now we've got a confirmation reversal. You can see real estate's not ready to move back into the lead. So I'm going to leave it there for you and send it back to you, Todd.
All right. Thanks very much. Good work there. And I wanted to just echo what Terry is saying. And this is a chart that, you know, I've been focusing on and really trying to guide our customers at Trading Analysis and our clients on the wealth management side that, you know, everyone is so focused on, and I'll turn it to you here, Alex, in just a sec. Everyone here is so focused on yield curve inversion, and this is the 10-2 spread. We got down to more than 100 basis points of inversion, down to 107. Well, with the rapid denial of the 10-year yield, 10 and 30-year, we've been keying off the 10 because that determines so many interest rates in the economy. With the denial at 4% down to 3.3, and now we're at 3.5, 3.6 in the 10-year. The 10-2 curve has, I don't know the right word. Is it de-inverted, disinverted, uninverted? If anybody knows, let me know the right way to say that. But you know, we're only at 60 basis points of inversion. And again, if we just scroll back, you can see we've had some pretty good periods of inversion, 07, 2000, this is going to be 89, and then in the 80s. But this is what the headlines are saying. This is what everyone's focused on, but you have to factor in inflation. You have to. I don't care if interest rates are 5%. If your loan that you're taking is being inflated away at 6 or 7%, you're still making money. That's good. So you want to look at the real yield curve. And this is, I think, one of the most important things. So this is the 30-year minus the 5-year. This is the nominal yield curve, not factoring in inflation, right? So if you go all the way back, we had some pretty significant inversion back in 2000. And the inversion, okay, again, between 30s and 5s, got down to 4%. We kind of double bottomed around 4%, and we're trying to get back into positive territory. But when you factor in inflation, and the reason I'm using the 5 is I can't find an index on the Fred database. I can't find an indexed inflation 2-year product. So that's why I'm using the 5. It's not ideal, but it's close. And if you look at the correlation between the real yield curve, 30-year minus 5-year, these are using inflation indexed 30 and 5-year Treasury securities. One, you can see the correlation with the S&P. It topped out here back in 21, and then the market took notice here later that year. But it's clearly a good correlation. And number two, we're trying to break out. We're going positive here on the real yield curve. So if you get above 18, 19 points of normally shaped yield curve, 5-year real treasury yield is 20 basis points less than the 30-year real 30-year yield. That's a good thing. That's a normally shaped real yield curve. And with interest rates stabilizing, a little over leveraged banking crisis, just enough to scare the Fed, and Powell might calm him down from being so tough and clubbing us over the head with 5.5% interest rates and 6% higher for longer. I think he's going to scale back that rhetoric quite a bit, and that could pave the way for a significant rally. I wanted to show you real quick, Alex. I'm going to bring you up. That Tesla again, I told you we would take a look at that, and I am completely ready and willing to address this. So if we have 190, 200 call spread, I still think Tesla can continue to move up here. Remember, consumer discretionary, it's, where is it? Tesla's right here. So here's the trade right here. We're 199.38 pre-market, so we might extend that call spread up. And what you can do is you can, to extend a call spread, you can buy back the 200 call, and maybe I'll sell a 205 or a 210. Keep the 190 and sort of extend that up. Another thing you could do is butterfly it off, right? If I could maybe go up, sell the 205, sell 205s, and I'll buy something maybe at 210 or 215 to kind of take profit on that call spread. And obviously, we're carrying all the stock positions as well. All right. Alex, we hit you a lot of macro, but why don't you jump in and tell us what you're seeing? You are up. And sorry, one sec. Audio, you are live. There you go, bud.
Okay, so just to show you a little bit situation in Europe, just to continue a little bit of a macro story. So this is the wave count we are tracking on the German government 10-year yields, which is kind of an equivalent of the European bond situation. And yesterday, Lagarde was again very stubborn in a sense that she said that ECB is going to continue actually hiking rates. Their goal is to put inflation around 2%. I think that's pretty wild from the central banks. But nevertheless, if we see what's going on these futures, which is 1 month, 3 months, and 6 months Euribor, we were a week ago at 4% until October 2023. Now we are on a 6 months at 344 and 1 month on a 341, which basically price in 1 or 2 more rate hikes, which kind of also agrees with our chart that this yield's first cycle on the upside will soon complete, and we have that also in the chart on the US 10-year. So I think you're completely right. I think economy is strong enough, especially in the US, to sustain this sideways to a little bit higher maybe in a month or two, and then we're going to see a big reversal technically to the downside, which was kind of our thesis for the beginning of 2023. So all goes well in that perspective. So you have shown the commodities. Thomson Reuters index is moving lower. Dollar index is now trading at support. Today is Fed with 25 basis points. Of course, depends on the narrative. I think we're going to see potentially this Y wave. You have, I think, this as a fourth wave. We might even continue lower. Maybe my wave count is not correct. I'm still holding it. Usually the X wave tests the previous B wave when you have a complex correction, and we are there. So I'm going to adjust this chart afterwards. But nevertheless, we do have, in any case, a 5 waves down, or we're going to have a 5 waves down, which actually tells us the dollar, after corrective pullback, now or a little bit later, it's going to continue lower, which actually announces either some problems or increasing liquidity in dollars, which will be beneficial for EM market, stock market, and the risk on assets classes. So I think our macro is kind of a well grounded with all of the facts. Of course, there is surprises, but I think it's going good for now. So what I want to show you also that our portfolio of stocks, which I work on, we do have a process where we select, Terry and Todd select stocks according to the RRG. Just to show you guys that usually we have, so our shorter term and longer term kind of possible positions are growing rapidly. So we are adding many stocks inside that, which means that these rotations are real because the wave count supports what Todd and Terry has been talking about previously in the rotation graph and on macro. Let me just show you Bitcoin. Bitcoin is also one of the headwinds for the risk on assets. So I'm going to show you the Bitcoin chart. Let me just go on a Bitcoin. Let's go on a smaller time frame. I'm going to show you daily. So I have this as a wave 4. This looks pretty impulsive. We are trading now above 200 moving average. So my best case scenario for Bitcoin was that this was a wave 4 in ongoing move on the upside from 2018. So wave 1, wave 2, wave 3, big flat in wave 4, and we're going to continue on the upside. Equality is around 30K, and we are almost there, 32K. And this looks pretty much impulsive, in my opinion, and a couple of other cryptos are in the same relatively bullish situation. So Bitcoin has been an indicator of the global liquidity for the last couple of years, and it actually reacts on the global liquidity because it's connected with it. And I think this starts to show a potential future developments in the Bitcoin, which might be pretty bullish on the smaller time frame. So we are looking for 5 waves up in one very nice pullback, which we basically warned. You can find that on my Twitter page. I have tweeted this when we were at 50% retracement, and from there we had a pretty nice push on the upside. I do expect some type of a pullback here. And what is good to remember, wherever you have a possibility of the 1-2-1-2 situation, wave 2 will be lesser in time and value than the higher degree wave 2, which means, and it's quite logical if you expect wave 3 of 3 to develop, this wave 2 of a lesser degree should be shorter.
Hey, Alex, with that pullback in white 2 and Bitcoin, is that dependent on that dollar holding this ABC pullback, or if Bitcoin does not retrace, does that push the dollar lower? Is Bitcoin responding to, like you said, more liquidity, lower dollar, rotation of the growth via contained interest rates? Like, what's the biggest macro driver of crypto right now?
Yeah, macro driver of crypto for most of the part was actually Nasdaq and SMH. So we have also the wave 2 on Nasdaq possible after this leading diagonal, and that as well corroborates with dollar higher and Bitcoin lower, following Nasdaq lower, dollar higher as well. So from two sides, this correction might play out on a macro theme. So that's why I try to kind of match all of this macro because it has been functioning pretty well, combining that with the Elliott Wave. So we do have this as a potential pullback as we see it on Nasdaq and as we see it on dollar on the upside.
Okay, and let me just jump in and say I have something different than you on the dollar. And listen, with Elliott Wave analysis, guys, and Alex, don't get off track. I'm going to send it right back to you. Okay.
Sure.
I don't tell anyone that their count is wrong. We are literally trying to assess the now, figure out what's happening now in the past to figure out what might happen in the future. We're literally trying to foretell the future. So there's nothing. I encourage debate among my team, Alex and Terry. These guys are excellent at it. I love looking at multiple scenarios. It's not a formulaic approach. It's assessing all of this available imperfect information to figure out our best path forward. So I have a different wave count, and if you study mine versus Alex, it's very subtle, the difference. I'm not going to get into it now just in the interest of time, but this one, my count says this is a fourth wave that squares up against this wave 2 in October 22. This one allows for a lower dollar. That lower dollar will allow for that Bitcoin to rip higher, tech to rip higher, foreign currencies to rip higher, bonds to rip higher. And I think it's really, really important. Alex was an institutional FX trader. Him and I have been doing Elliott Wave together for over a decade. I can't wait to see what happens. And it's just a subtle, different interpretation back here, which would have an impact on what our forecast is here. But I think it's really key. The A equals C or the 1 equals 3, the equality levels right here in the dollar index. This is spot dollar index 102.68. That's going to be a key level. If you break down through that on some kind of risk on rally, that would start to suggest this is not ABC based on Alex's count, but a 1, 2, 3 reaching the 1618. If we hold this and start to rally, that suggests I'm wrong, Alex is right. Get a pullback in Bitcoin, pull back in growth stocks, pull back in bonds, and we go under a little bit of a risk-off mode for a period of time. So that's a key distinction I really wanted to make. Alex, I'm going to put it back to you.
Yeah, sure. I mean, I think it's when we have this kind of a work as a team, as you pointed out, the multiple wave counts are advantage. It's not something that we. I mean, you never oppose it, and that's great. Because I mean, we are long doing it in Elliott Wave. So what is the probability that both of us wrong? I don't think it's big.
Well, so one of us is saying it goes down, and one of it says it goes up. So I think one of us would be right. But But it's putting the wave counts together based on all these macro relationships, that it's such a macro-driven market that we're trading the stock market. We're focused on growth stocks. But all of this stuff we're talking about helps us to give clarity as to what the wave count is. And frankly, if you guys haven't noticed, the wave count in the stock market and the indexes right now is a mess. It's a total mess. Because I've said this in prior streams, you have growth stocks that are still on the mat after they got their clock cleaned in 22. You have value stocks that rotated out hard. So you have a lot of forces keeping these indexes sideways. And there's some emerging, there's some buds, there's some green shoots that are trying to give the index leadership. But there's a lot of stocks in an index. It takes a lot to move those guys. So, you got to look at all the macro forces and the different wave counts that are impacting various sectors within the index that might give us the ability to break ranges. Okay, so we want to look at both sides of the equation. We have plan A, plan B. That's part of being a good trader and being a good investor. That's why Elliott Wave is not a long-term forecasting methodology, but a trader's methodology. We have plan A and we have plan B. I know exactly where I'm going if the dollar rallies post-Fed, and that's the Alex's count. If the dollar sells off, I know what my plan is. We have plan A, we have plan B. It's not about being right or wrong. It's about making money. And that's the difference between using Elliott Wave as an analyst and Elliott Wave as a trader and investor. Alex, back to you.
Yeah, so longer term, I mean, if we look this chart, especially if we study, usually when we have this type of pullbacks, I have this also as an ABC, but this is too sharp for my taste to consider it part of a C wave. Usually we study something which is an angle of ascent, and C waves usually have a typical kind of a 45, rarely 50 degree of the angle of ascent. They're usually low volume, choppy, sloppy affairs on the upside. This move up on Bitcoin is pretty vertical, which kind of flags potential, I'm just saying potential, short pullback and sharp continuation higher. which will basically put us in a growth stocks mode, and the better kind of a bigger liquidity into the system. Yeah, we are tracking a couple of course, over 50 cryptocurrencies for our members, and many of them are setting them up for at least a sizable move on the upside. So I think overall, when you put pieces together, we are looking for either last completion on the upside in US dollar, a little bit of pullback in Bitcoin and Nasdaq, and then off we go. When the dollar starts to move lower, everything will be synchronized, moving higher pretty rapidly and pretty sizably, in my opinion.
Very nice. Very nice. Good stuff. Good stuff. Good stuff. Alex, flip your camera back on.
Sure.
We need to talk about this. We have a webinar coming up tonight, and I am gonna, Scott, on the on my YouTube channel, Todd Gordon is asking a good question. I do want to jump into that. I will answer, but I do want to show you guys that we have a pretty important event coming up tonight. If you go to tradinganalysis.com/madness, tradinganalysis.com/madness for March Madness, we're doing a webinar tonight, an informational webinar on Motive Wave. They're doing their spring sale, biggest discount of the year. This is the software we use to do all of our analysis and go through it as we're looking at here. I mean, here's Spotify. I'm watching Spotify finally break out. But if we go through, I mean, we have a variety of different interpretations. Motive Wave allows you to organize, file, organize, keep track of your different wave counts. It allows you to do Elliott Wave very quickly. It allows us to share our wave counts with each other via the cloud and also to all of our customers who are connected to us. So it's like Elliott Wave learning accelerated multiple times. So it's key software. If you're an Elliott Wave guy and you're not on Motive Wave, you're at a huge disadvantage. So we have a webinar tonight, 8 o'clock. If you want to go to tradinganalysis.com/madness, you can sign up in there. Actually, Terry, where is our? Oh, it's going to be yeah.
I don't think we put the webinar link in there, did we?
All right. You know what? We'll drop it in while I'm talking. Will you guys grab that link and we'll drop it in for the sign up.
Yeah, let me find it real quick. I had
Thank you.
Yesterday. I was thinking about that. And didn't get back with you on that, but
okay.
Yeah, that 25% off. That's a huge opportunity. And guys, you've been watching us for a long time manipulate these Elliott waves, and you see how simple it is that we can adjust the count on the fly. And if you're still dropping and landing A, B, C, 1, 2, 3 manual, and it's a struggle to keep up with multiple counts. You don't have a good way to organize that. You don't have a good way to share it. And because it's difficult to manipulate, you may find yourself reluctant to change it because you don't want to go to all the effort to have to change it. And that could be detrimental to your trading. So
all right, we'll
link here in just a second, Todd.
Thanks so much. Appreciate that. I just want to take, let's see. Scott's asking a good question. Scott M. At Trading Analysis Channel. Could you point out the first wave of the fifth wave in the NASDAQ NDX leading diagonal? Looks like we just completed first of 5 up to complete the leading diagonal. Okay, I think I follow you. It's a good question. And I discussed it last night in the members video, exactly this. So let me just read this again. Thanks, Terry. So Scott says, Todd, could you point out the first, sorry, I'm not talking to the microphone. Point out the first wave of the fifth wave in the NASDAQ diagonal. Looks like we just completed the first of 5 to complete the leading diagonal. Yes. That is a great question, Scott, and it's an astute question. I don't want to get too crazy into this. My friend, and I call him a friend, Bob Prechter, we work together. I've been to his house, been on his boat, drank beers with him. Love him. He's a friend. He's from upstate New York. We worked together for a long period of time. He put some very specific rules on R.N. Elliott and Charles Collins and Robert Ray, who was doing it, and Hamilton Bolton. These are the forefathers of Elliott. He put some very specific rules on the diagonals, which creates a lot of confusion. Prechter said a good leading diagonal it really should show wave 1 being the longest, 3 the middle length, and 5 the shortest. However, there's a lot of times where, the ideal structure, the market in reality will take a different shape. What this is doing off the lows is, if you look at wave 1 compared to 3, 100% 3v1 was exceeded. So now 3 is the longest. Okay. So what does that mean? What does that mean? Well, okay, if 3 is the longest, okay, wave 5 is sort of unencumbered. Okay, so here's wave 5 of the diagonal. Here's a 38% 5e3. Here's a 61% 5e3. Here's 100%. It could go up to 100% 5e3. So your question, Scott, if this is a traditional diagonal, even though we snuck this much past length of 1% change versus this, if it's a traditional contracting diagonal, we should be shorter than wave 3 and 1. Okay, so what does that mean? So here's the distance in wave 1. All right, that's 100%. So this right here, this 13,658% distance traveled here is equal to here. Let's pull in a 618 in there. Okay, 618 is going to be right there. Let me get rid of everything else. Okay. So, all right, if we're going to be a traditional diagonal, which again, if 5 is going to be shorter, we might end here, Scott, and we might have to make this 5 wave move, to your question, all of this wave 5 right here. We might have one more push, and if we stay below 13,137, 12,820, it might be all of 5. If this thing is going to behave like a traditional motive wave, which is, we're going to have a wave 5 that might be the same distance as wave 1. That could be higher, 13 or maybe even 14. And this could be 1 of 5, which means we'll get a pullback here and then we make another push up. I don't know, because it's taking a non-traditional move. But listen, it's the first wave of a potential long-term uptrend. It's when a move is just getting started, I don't really care what the specifics of the 5-wave move. If it traces a 5-wave move, good enough for me. Where you will never see me take shortcuts with that is in the higher degree 3rd wave. That better be a clean 5-wave move with no interaction between 4 and 2, right? 4 and 2 better not be right there. So wave 3 of a higher degree better look nice and clean. Wave 1, it's just getting started. It's going to be sloppy, choppy. So that's why I'm confident, I'm somewhat confident saying the October lows are in. It's starting to look like a 5-wave move. If we break the February 2nd highs, it more suggests it's a 5-wave move, and where it ends, we shall see, okay? The other thing is, if I'm wrong, and this is A, B, C, X, and this is A, this is B, C wave is still going to carry you to 13 or 14K up into these objectives anyway, okay? So I'm bullish. I don't know exactly what the future holds. I wish I could tell you, but we do have a 5-wave move, and it's going to be very interesting, Scott, to see if this is all of orange 5 or if this is 1 of 5. And we'll know based on all those other macro forces that we talked about, where the sector rotation is, so on and so forth. Hopefully that helps, and I hope you're here to hear that long answer, but it was a good question.
Yeah, that's a lot of good finesse there, Todd, and maybe we can talk more about that tonight on the Motive Wave Sale webinar. So
yeah, appreciate it.
Did you drop that link in there for them on YouTube? There's the registration link for our Zoom call tonight.
Yeah, going to be a good presentation. I will drop in the link to, where'd you put that link, Terry?
In social media,
okay.
Slack.
Got it. Copy link. Okay, perfect. Thank you. I'm just dropping it in both YouTube windows right here. Here's the link. Boom. There's the one in trading analysis, and then here is in YouTube. And I know we're on LinkedIn. We're also on Facebook. I will drop those links in after, and we're also on Twitter. So guys, we're gonna leave it there. We have a good little opening print here. Markets are nice and quiet. I love it heading into Fed. Rates are up pretty good, 3.6 on the 10-year. Looking at the sectors, looks like energy's down, real estate's down, utilities down, everything else kind of quiet. Tech has a little bit of a bid.
Apple about to hit 160.
Oh yeah, Apple's breaking? Wow.
Yeah, 160.
Wow.
Remember, I told you yesterday it broke through 157, and that was a trigger point. So now we're at just shy of 160.
Here's the other thing.
Coming back up 1%.
Yeah, I mean, here's the other thing that's scary. I mean, look. I mean, if this is a correction, same thing. If I'm wrong, and this is A, this is B, and this is C. I mean, you're looking at 165, 170, 175 Apple, even in a bearish correction. If I'm wrong, which I hope and think I am, and we're in a wave 3, I mean, listen, I'm not tracing this. I'm not drawing these charts. The market's drawing it. 100% relationship of ongoing 3-1 is at the all-time highs in Apple. It's shocking. And you know, and the most important thing, Terry and Alex, Spotify broke out. We hold Spotify. It's starting to close the gap a little bit, but Spotify broke out of a triangle. We hold that in the stock swing portfolio. NVIDIA is coming up into a key 286 resistance level against the old 2022 highs. All-time highs are going to be 330. NVIDIA is absolutely tearing. And let's take a look at Tesla. Are we through 200? We are not, backing up a little bit, so that's fine. Against these old highs right here at the 100%. Again, I'd like to see this guy continue to move higher, but it might be chopped into the Fed. All right, closing comments, guys.
Let's continue this in our member webinar. We got a lot more to talk about with our subscribers. So.
A lot more to talk about. You're right. I'm going to play a quick video just talking about the Motive Wave repository. This is key to close this out. This is how you sync your Motive Wave workspace to us. Is we make changes. Literally, if I were to drop a target on here on Tesla commentary, what'll happen is if I say right there, Tesla target 212.25. All right, and if I drop that, hit save, that just immediately went out to all of our customers who are connected to us on Motive Wave. Any changes will come through in real time. Pretty awesome technology. Great to see wave counts updated in real time. That's how you shorten your learning curve. Guys, that was the chart I was just showing right there. 212 on Tesla went out to everyone. All right, thanks. Throw questions, comments, what you'd like to see in the next. Thumbs up. And we'll see you on the webinar this evening. Terry, Alex, great job. Thanks, guys. And we'll see you tonight.
All right.
Todd here with Trading Analysis. So I'm at the NASDAQ here, about to go on and do Power Lunch, talking about Tesla, but I want to talk to you about the Motive Wave repository. That's the charting package I just showed you. This repository program, what it does is it allows you to sync all of your analysis, your Elliott Wave and Fib, up in the cloud. So whenever you're traveling or going anywhere, you can just bring the analysis right with you. So I was just going over my Elliott Wave count for Tesla, which I'm going to be covering on air right here. So it's just very convenient for you to be able to do that. There's a lot of stuff that goes inside of doing the wave count, stuff like that. 1, 2, 3, 4. So whenever you're traveling, it's excellent to have that ready at your fingertips. The other thing, guys, is if you're learning Elliott Wave, the repository program, which is only offered through Motive Wave, allows you to sync your workspace to mine. So as I'm doing my Elliott Wave count, I literally can sync my wave count to yours wherever you are in the world, you're instantly going to get the wave count on your charts. It's like real and live time. So it's pretty awesome. It shortens your learning curve for Elliott. Really, I mean, when I first started, I'd have to wait for whatever analyst, there's a couple guys that I was following, wait for them to update their wave counts and then go and compare my work to theirs. It took forever, but you can shorten that learning curve with this repository program. So definitely check it out. It's so much faster than the old way of learning Elliott, which can be challenging, all right? So I'm gonna hop on and go do my wave counts over in Tesla. See you guys. Very much in line with the last decline, which was 34%. It's actually very symmetrical, very technical, very expected. So I do have long positions here. We've begun to break out. The shorts are really getting squeezed. I believe there's 39 million shares outstanding on the short side with 125 million market total outstanding. So those shorts are really coming in. I think it's going to continue to press higher and go up and retest these old highs.